Today, upcoming, stocks hit new high thanks to the Fed's latest move. Where to next? The latest GDP forecast. Intel rips up on an investment from Nvidia. Nuclear stocks continue to rally. The best hedge fund managers year to date. And it finally happened. We're riding one of the greatest waves in history here, guys. Let's go. Wow, what another monster day in the stock market. And this heat map of large cap stocks doesn't even show the true picture of what's really happening out there today. We have to switch over to the Russell 2000, as once again, all the action today is happening in small caps with a massive amount of breadth across the board, as they're the most reactive to interest rate cuts. As we got one yesterday with a few more penciled in over the coming months. Music to the market's ears here, helping the Russell 2000 small cap index finally break out to brand new all-time highs here today, after waiting 10 months from the prior highs back in late November last year. Nice to see it happened on a momentum upward thrust signal, showing that this was a really powerful move today after that big volume day yesterday. And so it's a great time to be a small cap stock investor. My portfolios are up big today across the board, and I hope yours are too, as we're getting a huge relative outperformance of small caps versus large caps. Just looking at the spread of the Russell versus the S&P 500 equal weight ETF, up almost 2% today on a momentum upward thrust signal. Small caps are now well and truly outperforming and still have plenty of room to go, because this spread is still well off highs. And what gets me so excited to stay invested in small cap stocks is most of the market isn't. Big institutional money have long abandoned them, and when they eventually come back, that could ignite a powerful multi-year trend of outperformance of small caps relative to large caps. As currently there's only 6% of all domestic equity ETF assets under management invested in small cap ETFs. That's an all-time low. Not to mention the relative valuations of small caps versus large caps is really in favor of smalls here. Looking at the S&P 500 forward earnings ratio, currently a bit above 22, but looking at the S&P 600 small cap index, that's still below 16, and looking back even as recently as 2020, that number went as high as 24, above its upper band here. So there's plenty of room to grow in small cap valuations, but there is still no shortage of bears out there. One of the most famous, Marko Kalanovic, former head of JP Morgan's investment research team. They actually had to let him go last year as it was too embarrassing for them to keep holding on to a perma bear. It's not really good for their reputation. He's gone off on his own and still calling for a top every other day, saying on X today, the bubble is one hot inflation or strong jobs print away from bursting. And that's the thing with perma bears, is it's too hard to let go, throw in the towel, because they feel like they're buying at the top and going to look even more stupid. So they hang on to that perma bear narrative. And then yes, when we do eventually get the correction crash bear market, we very well could be going into a bubble. They'll all turn around and say, look, I told you so. I told you it was a bubble. But I agree with this portfolio manager today. Bubble is just bear speak for I missed it, and is more a coping mechanism. The smarter thing to do is to ride the bubble. There's no telling how crazy it can get. And one guy that's been doing that really well is Tom Lee, who just came out today and said the Fed cut is beneficial to improve business confidence, get the ISM back above 50, lower interest rates helps housing, and it improves demand for non-cash assets as the yields on money market funds comes down. He sees the winners as being small caps financials, large cryptos, and the Mag 7. His ETFs and Ethereum treasury holding company, Bitmine Emergent Technologies, have been doing really well of late, and he's actually just filed to launch a new small cap ETF coming online soon as well. And because in addition to Tom Lee, I also agree with this journalist here today, the Fed will make small stocks beautiful again. Got that huge gap between the S&P 500 and the small cap 600 index. Heaps of room to catch up, and not even in small caps, we still could have a few years left in this secular bull market. Even though it naturally feels like it's really late, Bank of America thinks it could still go to 2029 or 2033, pointing to previous secular bull markets that lasted up to 20 years, and they measure the start from the all-time high breakout back in 2013. Remember, US stocks went nowhere for 13 years. It was more than a lost decade. Prior to that, we had a really long secular bull market, 1980 to 2000, again coming off a lost decade and a half. Even worse when you adjust for inflation. But what about this month? All the bears were telling us we're supposed to finish lower. September being the worst month of the year historically, catching a lot of people by surprise that we're rallying here. And so when the market does hit a new all-time high, like it did today in both the Russell and the S&P 500, that bullish signal in a bearish month bodes really well for forward return. On average, slapping on almost another 5% in Q4, 90% of the time. And it's very rare that we see a correction defined as 10% or more from all-time highs in that Q4. And just looking at sentiment indicators, they're really not too stretched here. Even though technically on the charts we are for sure in the short term, sentiment wise, not so much. The fear and greed index, not even quite back in the middle of the greed zone here at 62. And looking at the latest AAPL investor sentiment survey, well, as we always say, nothing changes people's minds like price action. The latest reading showing 41% bulls, almost close to taking over the amount of bearish readings. Still not quite there yet, but we've seen significant bearish tilts over the last few weeks, as the consensus throughout that time is we're right on the cusp of a pullback or correction. Just has not yet materialized. And again, just like the fear and greed index, that could have further to go. Just looking at the average bullish reading over this past few months, we're still well off where we were most of throughout 2024 and even late 23. And some out there are saying we're back to the craziness and froth of 2020 or 2021. I don't think so. We definitely could be on the way. There's plenty of momentum in meme stocks, crypto related names, but Bitcoin hasn't gone vertical yet. By a lot of measures, stock valuations are still below those 2021 highs. Plus, we don't have other crazy things like people paying $2.8 million for a picture of a rock like we saw in 2021. NFTs. So I still think there's potential for it to continue melting up. But like I said, here in the short term, no doubt we are a little technically stretched. I am seeing bearish reversal signals on the charts all over the place. And even the indice, S&P 500 RSI, has been above 45 for now 102 consecutive days. And the RSI is just as much a momentum indicator as it is an oscillator. So that just shows a lot of momentum in the market, but that can give us a pullback in the short term. Historically, when that happens, we're lower 2 weeks later. Not by much though, just a minor pullback, 2%. And we can see that on the chart of the S&P 500 ETF. Fourth reversal signal can only be max of 5 in a row. We are in a grinding environment here, so we very well can see a little consolidation next week. But again, the Russell 2000 hasn't even fired off the first reversal signal yet. And we got that massive outperformance today. S&P up not even 0.5%. The Russell doing about 5 times better. Big rotation. And this is coming on the back of a weakening jobs market. That's what prompted the Fed to start cutting rates in the first place. And this isn't something that's just started. Looking back in history, you'll see in this chart here a strong correlation between labor market conditions and the S&P 500. When the labor market weakens, so does the stock market. Labor market strengthens, so does the stock market. But for the last 2 years, we've had a massive divergence. What's that all about? Why isn't the stock market pulling back with the jobs market? Why didn't the historic yield curve inversion back in 22 and 23 give us a recession? Why didn't the Fed's fastest rate hiking cycle in 2022 give us a recession? I think the AI bull market overwhelmed that, not only in investor sentiment, but in the actual most important fundamental indicator of the stock market, and that's corporate earning. Companies keep making more money, and that's why the stock market keeps going up. And just looking at the latest weekly jobless claims, we actually had quite a good pullback today after we got that breakout last week. Like I said, it's important to pay attention to the moving averages because there can be a little bit of noise in the short term. But we'll be keeping an eye on this because a weakening jobs market could still eventually spill over into the economy. But whether that causes a big pullback in corporate earnings is still yet to be seen. But what the market is more and more confident about is that interest rates are going to keep coming down. Fed Fund futures already pricing in 92% chance we're going to get another cut next month, and a good chance we're going to get another one in December. And the Fed themselves forecast that they will get their overnight rate to the mid threes next year and potentially the low threes come 2027. And they forecast economic growth to continue accelerating to almost 2% above inflation by 27. And I think they've been quite optimistic in their forecasts of the unemployment rate because Jay Powell even admitted yesterday AI is starting to eat into the jobs market. And after telling us all year that tariffs are going to cause a big wave of inflation, that's why he has to stay on pause, all of a sudden he's saying, well, maybe not so much. And again, they're forecasting inflation to come down next year. And so looking back in history, when the Fed cuts, especially with stocks already at all-time highs, corporate earnings accelerating, GDP holding up, it's kind of just like pouring fuel on the fire, giving the bull market a shot in the arm. Looking back in history at a composite chart of how the S&P acts after the Fed's first cut after being on pause, looks pretty good going forward, 12-month average gain above 15%. And we do seem to be following a similar path to 1998, like I showed on yesterday's daily market review. Greenspan was worried about the weakening jobs market back then as well. Stocks were at all-time highs. Thanks to the internet boom, they did 3 cuts. The Nasdaq literally more than doubled again over the next year. And here we are in the black line. After 1998, here in the blue line, had a similar sell-off. After the large hedge fund, long-term capital management, caused a big bout of volatility in market, they quickly bounced back. And overall, the S&P 500 is on target to grow earnings at 12% this year. This is pretty good growth here, making the earnings yield on the stock market as a whole still above short-term bonds. I think we may not potentially see the top until bonds yield significantly more than stocks, and that could finally cause a change in sentiment and massive rotations. But for the here and now, the US economy is forecast to keep growing quite well. In fact, looking at prediction markets, the odds are favoring that Q3 GDP growth should come in at an annualized rate above 3.5%, which is very good. Remember, for us to get a recession, we need 2 consecutive quarters of negative GDP growth, and those odds are coming down and down. I would say it's almost impossible now that we could get a recession in 2025. Q3 would have to come in negative, so would Q4. And just looking at some key indicators in the economy, important transport stock FedEx actually came in with a good beat, expecting between 4 and 6% revenue growth for the full year and providing a healthy outlook as well. Just got the earnings after hours, beat Wall Street estimates by 6%, and the stock's up quite well, over 5% in post-market trading. And that should help the transportation sector as a whole, which is still yet to break out to all-time highs, and that's what we need for Dow theory. Both the Dow Jones Industrials, which once again hit all-time highs today, and the transports, both breaking out to 52-week highs. And that's important because companies like FedEx are an indicator of how many goods are being moved around the economy. And so that, in addition to retail spending, coming in at 5% year-over-year growth this week, shows the US economy is still healthy right here and now. There's just weakness in the labor market, but we can see from the price action in the retail sector, the stock market's not too worried about consumer spending. And so just looking at risk-sensitive assets like Bitcoin, it is looking constructive here on the chart, holding above the 50-day VWAP, still a little bit off all-time highs, but it hasn't gone vertical yet, even though we're getting plenty of moves in crypto-related stocks. The aptly named Bullish, crypto exchange and owner of popular website CoinDesk, came in with a good earnings result today, actually posting a second quarter profit of $108 million compared to a loss a year ago. Seeing volume activity rise, and that helped the stock have a monster rip today, up 20% after it had been beaten down a bit after its initial public offer last month. And what's been performing really well so far this month are Bitcoin miners, kind of pivoting to also offering their immense compute power as a rentable service. One of the best out there being Iron, stock we've been invested in for a few months. Now up almost 120% from when I gave it out to members and purchased it back in mid-July. That is just one of a few really ripping up of late, and we can see that in some of the hottest ETFs so far this month. The CoinShares Bitcoin Mining ETF, up over 34% month to date. Similar story again for the Charles Schwab Crypto Thematic ETF, holding crypto-related companies, significantly outperforming what the underlying crypto Bitcoin is doing. Like I said, they're starting to morph into the AI data center play as well. And again, with the Global X Blockchain ETF, holding a bunch of these Bitcoin mining companies doing very well. What's also been on a tear this month, global miners. We can see that in the iShares Global Gold Miners ETF ring. In addition to uranium, the Sprott Junior Uranium Miners ETF also having a good month here. But just looking at some of these Bitcoin mining ETFs, like I said, we're getting plenty of short-term reversal signals out there at the moment. Things are stretched here in the short term. So in my opinion, not really a time to be initiating new swing long positions, but rather let profits ride. And so just be careful with chasing stretched names. There's actually a thing known as the short-term reversal effect in stocks, showing that stocks, and in fact all assets that have really high returns over the past month can quite often earn negative abnormal returns the following month. And that's because investors can get a little too excited in the short term. Then we get that reversion to the mean. Doesn't mean the long-term trend is over. Just means we could get a pullback. And in fact, Quantpedia tested this as a system. Looking at the 100 biggest companies by market cap, the strategy goes long on the 10 stocks with the lowest performance in the previous week and short the 10 stocks with the greatest performance of the prior month. The portfolio is rebalanced weekly. And that actually delivers a decent Sharpe ratio above 1, average annual performance 16.2%, and a sizable drawdown, but nonetheless, that's better than the S&P 500, which actually had a bigger drawdown than that going into 2009. And so this short-term reversion to the mean after extreme returns is something I've baked into my own momentum formula that I'll be using to run my new ETF portfolio strategy. It discounts the past month's returns, places more focus on the prior 6 to 12 month returns of an asset. And doing that, it can actually buy the dips and healthy uptrend. And so if you'd like to learn more about my momentum strategy and upcoming ETF portfolio service, then come back to the Click Capital channel on Monday after market close, as I'll be doing a slide deck presentation in the daily market review, giving you more details about this. So make sure you stay tuned in for that. I think you'll find it really interesting and potentially eye-opening as well, as I've built my strategy around well-researched and proven patterns in the market that hold up over time. And I've been running this strategy myself for almost 3 years now, helping me to achieve really good returns in one of my accounts. Click the link below this video if you want to learn more about that. All right, it's getting back to the big headlines today. We got a zinger. Nvidia to invest $5 billion in Intel, sending shares sharply higher. And this is awesome to see. After the US government took a 10% stake, we now got the world's largest company also reaching out and helping their former competitor. Intel stood head and shoulders above Nvidia for years and years. Now Nvidia is literally 40 times the size of Intel. So they're investing $5 billion at $23.28 a share to jointly develop data center and personal computing product. As I've been arguing pretty much all year, Intel is of strategic importance to America in their quest to onshore chip production, be less reliant on other countries. And I think this is a smart move for all involved. And the government actually just did taxpayers a solid, as their stake in Intel is already up over $4.4 billion. Not bad at all. And there's a look at Intel on the daily chart. Monster gap up today, still finished up 22%. And as you guys know, I've been playing this all year. I don't have it in my long-term portfolio, but I've been swing trading it, buying the dips every time my indicators suggest we're near support levels. And it's worked out quite well. But it's going out to the monthly chart, still quite a lot of room to catch up here. Looks like we've completed stage 4 decline, stage 1 accumulation, and we've gone into that sweet spot of stage 2 advance, technically speaking here. Market cap 142 billion. And so this could be the start of a classic turnaround story for one of America's most iconic brands that is not just some gimmick product, but like I said, of national strategic importance. And the market didn't seem to mind the big dog Nvidia doing that as well. Shares climbing 3.5% today. And so to power all those electricity hungry data centers, already driving the price up of electricity, the government's putting its full weight behind the nuclear industry. Remember, there's nothing more big and powerful in markets than governments. That's why you got to pay attention to them. With nuclear stocks up again today, as the leaders of the US and UK agree to pursue nuclear energy together, making big investments along with deregulation. You look back in history, whenever governments really deregulate an industry, kind of helps to light a fire underneath it, gives it plenty of tailwind and attracts a lot of investment, kind of really opens the floodgates for more to come. And so that once again helped the uranium ETF rip up here today to yearly highs, along with the nuclear Renaissance Index ETF and some of those small modular reactor companies like Oklo also breaking out to all-time highs here. And we're continually getting more and more advancements in AI technology. So this year has been huge for not only chatbots and then morphing from answer machines into assistants that can complete tasks for you, but also advancements in AI video technology. And I thought I'd share one with you guys today. This is Ray 3, the world's first reasoning video model and the first to generate studio-grade HDR. And I'll just play this short 1-minute clip for you and check it out for yourself. The quality of graphics from AI videos nowadays.
When you close your eyes, what do you see? When we talk about reality, how do you know what is real? Or what is simply your imagination? Now open your eyes.
So as you can see, it's quite impressive. Pretty soon they'll be able to make entire movies using AI and we'll struggle to tell the difference. And this is not just for Hollywood either. Soon we'll be able to create fully explorable virtual 3D worlds based on our own imagination. And here's another example from the World Labs, a spatial intelligence company building large world models to perceive, generate, and interact with the 3D world. Again, I'll just play you this short clip so you can get an idea yourself of how far it's actually come. And so it's not only the online world with content, video, chatbots, your own personal assistant. The next phase for AI is manifesting itself in the real world. And in fact, one of my members just shared with me today this article here. The first AI-generated government minister was just appointed by the Albania Prime Minister to oversee decisions on public tenders and make them 100% corruption-free. No doubt controversial and could come across a little dystopian, but I think it'll achieve their objective of removing corruption. A lot of these small countries, government officials hand out contracts to their buddies and cousins, which pretty much just rips off the taxpayer as there's no competition for a tender on a project. Whereas now you've got a neutral AI bot, and of course they'll have to ensure that it stays neutral, which hopefully they put its code on a transparent blockchain or public ledger for all to see. And so AI and robots is not just coming for manual labor jobs, but even politicians as well. And I'm sure many of us would like to see more of that, as what politicians often do can differ from what most of the public actually wants done. And so not only will AI and robotics replace, but it's also expanding what we can do individually and as companies. I think we're going to see a massive jump in productivity over the coming years. And that's typically linked with economic growth as well. And I agree with this post here from David Scott Patterson. Tesla alone could easily supply enough humanoid robots to replace all human labor by 2030. And I know that's a wild claim, but he breaks down the numbers that there's about 80 million jobs in the US that involve manual labor. A humanoid robot can replace 4 workers by working 4 shifts a week. A production rate of 5 million humanoids per year could replace all manual jobs in just 4 years. And of course, that's a very optimistic forecast. I don't think that'll all happen by 2030, maybe 2035 or 2040. But humanoid robots do have about 20 times less mass than a car. Production of 5 million humanoids would be equivalent to 250,000 cars, less than 2% of the cars sold in the US each year. Humanoid robots, autonomous vehicles, and automation will massively expand economic output many times over in just a few years. And we're going to get another taste of that in a month and a half with the next Tesla shareholder meeting. And apparently Elon is going to be on stage dancing with the latest Optimus bots V3, which he says is the breakthrough in humanoids. Thanks to increased dexterity in their hands, making them pretty much human-like, he thinks, along with the latest AI chips, allowing them to read the real world. And I mean, just the V2 Optimus bots are impressive. Just to give you an example, here's a guy at a Tesla diner who tried to prank one of them, serving him popcorn, only to get pranked back by the Optimus bot. Take a look for yourself. And so this could be the next catalyst for the Tesla stock price. The annual shareholder meeting, Thursday, November 6th, leading with a graphic of the Optimus bot. No doubt that's going to be a big focus, in addition to robo-taxis, as they also work to convince shareholders in the market of Elon Musk's new pay package, the biggest in history, which as a shareholder I agree with. He owns nothing unless he hits on these big goals. Incredibly ambitious. He has to sell more than 1 million robots and make Tesla the largest company in the world. If he does that, he will be the world's first trillionaire, and I believe that he will. Because I believe we're on the cusp of some of the biggest revolutions in history with Tesla leading it. And I have no doubt in my mind that they will eventually overtake Nvidia, Microsoft, Apple, and become the largest company in the world, potentially in the next couple of years before 2030. As I believe this will be the biggest and most consequential product of our lifetimes, the Optimus bot, and it's still very early days. We're just getting started. And there's a look at Tesla stock price. Like many names out there, we're a little short-term stretched here, but very well, it could take a run at all-time highs, getting above $500 a share, potentially in Q4. We just want to keep seeing the successful rollout of the robo-taxi and no big safety incidents, which could affect public confidence and slow regulations down. And when you think about it, the internet, which has now been around longer than 30 years, I'm talking mainstream. America started getting online in the mid-90s. It's still growing with many use cases. Then the cloud really took off in the 2000s. That's still scaling rapidly. The first smartphone came in 2007, seen 15 years of growth. GPT's barely 3 years old. That's what really kicked off the AI boom, just like Netscape Navigator, the first web browser, did back in 95. So again, I still think we're very early days on AI. And again, Tesla could be a big time leader on AI, with rumors of them making an investment in Elon's other company, XAI, and may even potentially be a tie-up or big partnership of some sort, as both companies have access to incredible amounts of data and could create a lot of cost synergies with shared compute power. And so electric vehicles has been the story of the last 10 years. AI, automation, and robots will be the story of Tesla for the next 10 years. And just moving on, looking at a collection of famous hedge fund managers and what their returns have been so far year to date as we quickly approach Q4. Coming out on top, David Tepper, thanks to his big bets on China earlier this year. He also bought the dip on United Health. Other notable names, Tom Lee and Kathy Wood with their ARK fund coming back. Michael Burry doing a little bit better than the market, but a few others, including even Warren Buffett, not really having a great year. A lot of these guys investing in old economy style stocks, with many of them like consumer staples and others actually falling hard over the last couple of months. It's really been a story of growth stocks and momentum in the markets. My ETF portfolio strategy on track to have a 30% plus year, but I'm not going to be unrealistic and say that's going to happen every year. I'd like to think long term it can average somewhere around 20%. We do have a big global bull market, so 30-40% returns are definitely possible. But I wanted to show you guys something today, and that's the long-term power of even earning 15% a year, along with the power of dollar cost averaging, DCA. And so just to start with an example, the stock market on average, the last 50 years or so, has been delivering an average annual rate of return of around 10%. And so I just wanted to show you guys a quick example of what earning even just a couple of extra percentage points does over the long term, in addition to monthly dollar cost averaging. So in this example here, starting with $25,000, investing for 25 years at an average annual rate of return of 10%, but not contributing anything, takes that $25,000 into $270,000. And again, definitely nothing wrong with that. But that $270,000 turns into $822,000 by just earning an extra 5% a year. Again, starting with $25,000, invested over 25 years at an average annual return of 15%. The total return goes up by more than threefold. It gets exponential, $822,000. But taking it a step further, again, starting with $25,000, investing over 25 years, earning an average annual return of 15%, and just contributing $250 a month, which most people can afford to do. Some can do even a little more. That 870 turns into over 1.4 million. And so that's the power of long-term investing, doing a little bit better than the market. You don't have to reach for the stars and try and make 50% or more a year. You're likely going to be too leveraged, and the drawdowns from trying to do that will likely wipe you out. But also just contributing even just a couple of $100 a month exponentially grows the end result from not contributing anything, earning a market rate of return. The final amount goes from $270,000 to almost $1.5 million in the same period of time. And that's why good investing is just as much about staying invested, having a good strategy that can outperform the market in the long run, and just contributing even a little bit of savings per month. It all adds up in the long run. And so a lot of people might not get excited by 15-20% returns or even 30%. Might say, oh, my portfolio is up 40% or something this year, which yes, is definitely possible in a roaring bull market with tech stocks, crypto, and a few other things doing really well, but that may not always be the case every year. And it's how you hold up when the market goes into a bear market that shows your true strength as an investor. And so for all you young guys out there, the earlier you start, the more disciplined you are, the better off you'll be in the long run. But for all of us middle-aged and older guys, it's never too late as well. Just moving on to BlackBerry, stock I profiled last week, having a good day on the back of some more positive news, being the first mobile device management vendor to be certified by the German Federal Office for Information Security. As this company integrates more and more with not only big companies like Nvidia and Qualcomm, but also governments in cybersecurity, communications, and operating systems for large mobile devices like cars and potentially soon to be robotics. So it'll be interesting to hear earnings from them this time next week. Otherwise, just wrapping it up, looking at big assets, US government bond 10-year yield. It's nice to see that stabilize. I think that's a good sign for the market there, helping to see a pullback in bonds TLT today. And once again, volatility in the market very low with the VIX at 15.6. And we actually just saw the bond market VIX, move index, break down to yearly lows, showing that financial markets are very calm as the S&P 500 continues to grind higher. But what really did it for me today was the Russell 2000 breaking out to brand new all-time highs after waiting 10 months to get back here. It's a great time to be in markets. I hope you're making money out there today. Thanks very much for tuning in to Click Capital, and I look forward to breaking it all down for you again this time tomorrow. Cheers.